Good afternoon, everyone. I'm going to try to navigate here. Hopefully you guys can see my video as well as my screen. I think if you have my video pulled up, you can either double click on it if you want to just keep it there with a slideshow, which would be great. I'll try to get this tilted here appropriately. And we're going to jump through. This is our webinar number 4. Again, we're committed to reaching out to our clients and to the overall community, and hopefully just provide you an update on what's going on. Things are changing really rapidly. It's pretty amazing how much is happening on a day-to-day and week-to-week basis. It's now March 31st. We've now been going through this for roughly about a month or so, at least kind of through what I guess we could call some of the panic and some of the obviously the big issues for our economy and the stock market. So today we're going to just give an update on where things are with the health issues, kind of high level, give you some of Raymond James' perspective. And then additionally, and I guess more importantly, we're going to go through the CARES Act. So I'm going to make sure we're looking at let's see what we're looking at here. Make sure I'm looking at the right screen here. My team may need to help me if I'm not moving it on appropriately. Okay, so our outline for today, again, sorry, just real quick, this is John Vance, president of Vance Wealth, giving you our weekly update. Again, we're committed to doing these until we need to. So I know this is hopefully a good way to stay connected. I've seen some of your faces as we've had some meetings and some calls. So keep up with the requests. If you need us, we're here to help. That's the least of what we can do, is be available during this really tough time. Hopefully these webinars are taking a lot of the information, a lot of noise that's out there, and trying to sift this down to some information that's digestible. Now, with that being said, as I get into this content, the CARES Act is pretty large. So we're going to go through the summary of the CARES Act. We're going to give an update on COVID-19, what's going on with the policymakers, talk a little bit about portfolio rebalancing, which we're on the verge of doing. One of the things we're not going to do, and I just want to apologize ahead of time, is we were going to go through a little bit more planning, a little bit more investment opportunities. The reason why we're going to push this back a week is that the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act, so we're all going to become pretty familiar with that. Congress likes to put together these fun names. That was signed into law by President Trump on Friday. So this is kind of hijacking our conversation today. That way I can really go through and discuss with you guys what's in this bill. Now, high level stuff. This is a $2.2 trillion stimulus package, which is the largest emergency aid package in U.S. history. And it's really obviously here to stem the impact of us having to close down the government, close down many cities. One of the things when you look at this, it's really designed to impact consumers, specific industries, and really a lot of, employers of all size, but clearly aimed at impacting the small business community. One thing is just kind of a warning, it is 880 pages. No, I have not read it yet. So I'm sure there's a lot of stuff buried in there, like our government likes to do, is just bury stuff in bills. What I'm going to focus on today is some of the high level stuff. I know we're all getting bombarded with information. This information can be a lot better than what's coming off of either Fox or CNN or CNBC for sure. So hopefully this is some digestible information that's useful. Because a big part of this bill was aimed at small business relief, I am going to get into the weeds a little bit on this because this is an area that we work with a lot of small business owners. And if you're not a small business owner, you might have family or children that are business owners. So hopefully this is something you can pass on. This will be recorded, so you can feel free to share this. And so that's basically just high level of what the CARES Act is. So we're going to go through a couple sections here. And again, this is all new to me, so some of this I am reading because I haven't clearly memorized this. But first and foremost, individual stimulus payments. And so remember, this is phase 3 of a stimulus package. They already put some in place for lengthening unemployment, sick leave, family leave. They've already put that. That was phase 2. So this is phase 3. And the specific issue, and I talked a little bit about this a few weeks ago, was that the government's going to do what they can to get money in people's hands. they know that obviously stopping the economic engine it can't happen. And so they got to put money in people's hands so that the economy continues to move forward. And clearly that's what this is trying to do. We know there's no silver bullet. They cannot fix all pain for everyone. But this is trying to remedy some of the financial stress and also keep the economy moving forward. So what we're looking at right now is that the stimulus payments, which I think are going to go out somewhere in middle of April, that's the target, is that eligible taxpayers, which basically as a single person, you'll get $1,200. If you're married filing jointly, you'll get $2,400 plus $500 for each child under the age of 17. So the note below says no limitations based on tax liability or minimum level of income. So this means it's going to go out to people that don't have income, potentially people who owe back taxes. So this is just going to go out as a stimulus. What this is not going to actually go to are what the government deems as higher earners. So if you notice here, payments are going to be phased out for every $100 above certain levels. And so if your adjusted gross income as an individual is $75,000, or your adjusted gross income as a married couple is $150,000, you will start getting phased out, and you're fully phased out. Basically, individuals $100,000 and couples at $200,000. So if you're in that category, you're not getting any relief here. Hopefully, you still have your job. Hopefully, you're in a position where you're okay. I think that's what they decided is the major relief needs to come with get to people who potentially are living more paycheck to paycheck that don't have any savings to draw on. Now, I know being in California, this is not, having this level of income is not deemed as wealthy for sure, but it is what it is. This is what came out. And so these payments are going to be coming out shortly, and I don't know the duration of it. This is what the initial package is. It is clear with the government, if this goes on longer, we might be getting more checks down the road. So we'll see, but this is the individual piece of this. The next piece is regarding retirement plans. And so this does apply pretty much across the gamut. You could be a new worker in your 20s or well into your retirement. And so we're going to go through a couple high level things. So for younger taxpayers, you can now withdraw money from your IRAs or 401k plans up to $100,000 from their plan without having to pay the 10% penalty. Now, they're saying this has to be corona related distribution. Whether you're infected or you have economically been harmed. I think they're going to have a hard time proving whether or not you are economically harmed by the coronavirus. I think pretty much most people can make that case. So it basically gives a fair amount of liquidity to come out of retirement accounts. Again, the 10% penalty is going to be waived for taxpayers younger than 59 and a half, but you still will owe tax. And so the good news with this is that if you truly are in hardship, or you have anyone in your family that's in hardship, this money can be recontributed to those plans within 3 years, meaning you take the money out and you use that for whatever you deem necessary, and then you repay it within 3 years. You can get the money back in the plan without having to pay the tax bill. One really key part of this is for my retiree clients, and basically this is anyone who has to take a required minimum distribution. They are actually waiving the requirements for 2020. So if you're required to take a distribution this year, then they waive this requirement. So you do not have to take a required minimum distribution. Now, this doesn't mean you may not opt to. You still are allowed to take money out. You're just not required to. So from a planning perspective, this is something we'll get into all of you individually because this has to do with your cash flow needs. But it's nice relief for those of you who don't need this money. And then if you have a defined benefit plan, they've extended some of that as well. So I'm not going to try to read through all of this. Okay, so a big part of this emergency relief for business owners is really for small business owners, and it's something called the Paycheck Protection Program. Essentially, this is designed to basically help stimulate this economy, keep people working. That's the main thing that they're trying to design here is how do we keep people working? How do we keep small businesses from laying everyone off? We got to keep these paychecks coming in. And so what can we do to help stimulate that? And so to be eligible, you have to have fewer than 500 employees. This does include sole proprietors and nonprofits. So a lot of times sole proprietor, independent contractors were excluded from this. Sole proprietors and independent contractors are actually going to be included in this. One quick note, I literally, I think 20 minutes before I started this talk, the form that you need to fill out, it's about 4 pages, is now available on the SBA website. It has not been available on there. So if you type in SBA loans and type in the PPP or the Paycheck Protection Program, you can go on there and fill this out if this is applicable to your situation. And so the one thing that kind of gets into the weeds here that I'm going to read, and so how did they determine what you're eligible to get in this Paycheck Protection Program? And the reason why this is appealing to so many people is if all your requirements are met, this looks like this is going to be a full grant, which means that you will be getting this as essentially we could view it as a gift. So it's a grant. Now, there are certain terms, and again, from a compliance and regulatory, I'm not an attorney, I'm not familiar with the law, so these are things you're going to need to work with people inside your company, or you're going to need to work with your adequate professional, whether that's your CPA, your tax professional, or with your attorney if they have employment law experience with what's going on here. But the third paragraph down is what I'm going to read. So what they will do is they'll say, okay, I'm going to take the sum of your business's average monthly payroll cost for a 1-year period and basically multiply it by 2.5, which is essentially by 250%. And that is the amount that then you essentially can borrow under this Paycheck Protection Program. And again, if you utilize this for if you utilize this program and you qualify, it looks like this will be forgiven as a grant. And so again, there's lots of provisions that have to go into that. But as a simple example, let's say if $100,000 is your average monthly payroll cost, which includes payroll, which includes rent, utilities, and debt service requirements. So all of that together, if it's $100,000, that means that multiply that by 2.5, that means $250,000 would be eligible for this. And so $250,000 would be eligible for this. So pretty substantial for most businesses. Obviously, companies across America are going to sign up for this. And so if this applies to you, if you need the relief, then we would recommend you take a look at this as a good option. This is the section on forgiveness. Okay, so they're going to look at forgiving this, and basically they're going to be, and so if you look at the bottom of this, it says loan forgiveness is contingent upon the employer not reducing its workforce during the 8-week period compared to other periods in 2019 or 2020. And then not reducing the salary or wages to any employee who has earned less than $100,000 in annualized salary by more than 25%. So what they're trying to encourage here is you keep your people working and you don't give them massive pay cuts. And by doing so, keep them people working, the economy keeps moving forward. And then this will basically, in this example, you'll be getting a forgiveness of that amount that you took in terms of the Paycheck Protection Program. So I know I'm moving through this fast. Sorry about that. But there's lots to cover, so I have to. And I want to keep you guys coming back, and I want to keep these to like 25 minutes to a half hour. So hopefully we're moving right along. Employee retention credit. So there's also something in place that is giving you a credit against some payroll taxes. You can read through this. We'll make these slides available. I'm not an expert on all these areas. I just want to make you aware of some of these. So if you retain your employees, you'll be eligible for a tax credit, a credit against some of the employer share of Social Security tax. They also will give you a little bit of a break on paying back some of your payroll taxes. So for wages that are going to be paid after March 12th, then you'll have the ability to actually essentially get a refundable payroll tax credit. And so there's some really cool pieces to this that can help business owners. So again, these are going to be things that we're going to have to become better at. These are things that your accountant's going to have to become better at. And so this is hot off the presses from last Friday. So we're still learning as we go. Deferral of payroll tax and self-employment taxes. So this is the other piece, kind of to piggyback on the last slide, is that payroll taxes are normally due between now and the end of the year. So anything that's due basically this year, you can defer that until the following year. So you can defer your payroll taxes a full year, half of it a full year and half of it almost up to 2 years. And so if cash flow is really tight, this is not a way you get away from paying your payroll tax. It just defers the collection of it. So obviously, if you're in a business that's healthy and cash flow is strong, do you really want to have this debt to the IRS? Probably not. But if cash flow is tight, cash is everything. So you want to hold on to that cash and utilize this program to enable you to extend, to keep more cash in your bank and to be able to continue to operate your business. And so this is a deferral of payroll taxes and self-employment taxes. So this applies for, business owners as well as independent contractors, self-employed individuals as well. Okay, oh, hold on, one quick note at the bottom. This deferral is not available to any business that takes out a payroll protection loan as described earlier in this document. So if the payroll protection piece makes sense for you and you want to get the grant, if you're doing that, then you're not eligible for this deferral. So it's kind of either or. So you probably could pretty quickly figure out what's the better deal for you, but just wanted to be clear on that. Another thing, net operating losses. Don't want to get into the weeds to this, but for businesses that had losses that basically during the tax years 18 and 19 and potentially in 20, they actually will be permitted to carry back those losses for up to 5 years. And so this could obviously be a big help to businesses that maybe paid a ton in taxes in past years, and they want to try to carry back those losses. I am not an accountant, so this starts to get into complexity around accounting rules. So if you think this might apply to you, meaning you're looking at your business and you may have had a loss, you're going to have a loss this year, or you may have had one last year, you might have some options to go back and alleviate some tax liability in the past, or you can use this to alleviate some tax liability in the future. So this is a hot button for business owners that might have some choppy operating income, some actually choppy operating results, and have some losses. This is something that might help give them some relief now. Okay, so I went through a bunch of large slides. Now we're going to look at some smaller ones. So every Monday, Raymond James has been putting out a really good webinar that I've been listening to. They're helping actually feed some of this content that I'm providing today. So we just now got to some of the Raymond James slides. So this is coming right from our healthcare policy expert, Chris Meekins, and we'll share the webinar for Raymond James if you would like. It's a little lengthy, a little heavy, but some of you want to get into the technical stuff, it's not bad. The first line on there says, as we have been saying for 2 months now, we hope we are wrong. It will get worse before it gets better. It's clearly happening right now. So as of Monday, we had 150,000 identified cases in the US and about 2,500 deaths. That number is changing. I think we're at the clip of about 20,000 people are being diagnosed with this, are being identified or tested with this, 20,000 a day. So that's obviously ramped up quite a bit. And so clearly the medical piece is getting worse. That's one of the hardest things I think for us to kind of wrap our mind around is, okay, the medical piece is getting worse. Does that mean the stock market's going to get worse? Does that mean the economy is going to get worse? Or are they going to start to disconnect where the medical continues to decline until we get through this, but we start seeing a recovery at the economic level and at the market level? And that's what we think, is that we're going to start seeing the economy and things start to move forward even before the medical piece completely unwinds itself. So Raymond James did a really good job of laying out these scenarios. And so they actually have now shortened this into one slide. How does this end? The virus stops spreading is one option, or people stop worrying about the spread of the virus. So I guess that's one of two things, right? And so people stop worrying about it, may mean that we have more testing, more effective testing, or people just stop caring about it and it's just a reality that we start dealing with. I have no idea where this is going to go, but what's pretty fascinating about the layout of what Raymond James has kind of put together is these two scenarios. Eventually we get it, which is a 40% probability. I will tell you, last week that was 45%, so this one's gone down a little bit, and their saved by summer scenario was 35%. Last meeting, it's now 40. So in these two scenarios, and I know this is, we have kind of a collective a sigh here, and it's not a sigh of relief, it's a sigh of disappointment, that in scenario 2 means we eventually get it and we're back to business, we turn the corner around Memorial Day. Yes, that means, like 60 more days of this. And then scenario 3 is saved by the summer, which is we turn the corner around July 4th, which, is 90 days. So neither of those scenarios I know sound great for any of us, but that seems like it's likely. It seems like, I think, especially from a political perspective, everyone's been hoping to get this thing through faster. Doesn't seem like that's going to be the case. And so these scenarios is kind of what we're planning for. You're starting to see more schools, more states kind of push these dates back. So we'll see what happens, but that was kind of an update that Raymond James actually pushed the timing back a little bit on the Save by Summer. So stay tuned for that. All right, so lots of stuff going on here. The big thing that happened, the simple fact is the economy is slowing. There's a bunch of segments of our economy that have just stopped. If you look at airline traffic, how much lower it is over just the past several weeks, it's kind of fallen off of a cliff. Gone from almost, it looks like this is an 80% decline. You can see jobless claims. You know, we surpassed 3 million. It's the highest that it's ever been. And we had a big drag on consumer sentiment. So that means people are becoming more pessimistic, which again, that makes sense. It's a natural part of what's happening. So we are seeing the sharp decline. That's one of the reasons the market sold off. The markets that were early on anticipating this sold off. That's why we're here today. Now a lot of this economic data is not really a surprise anymore. It's kind of factored into what's going on with the government's response, as well as what's going on with the stock market response, right? With the economic response. That's what's been factored into this. Is we kind of knew this bad news was coming, and it's here. The one thing that has been clear, what's on the right-hand side, is the Fed's balance sheet. It's at a record high. So if you notice back here, the balance sheet, which basically means the Federal Reserve printing money and buying assets with it, prior to 2008 was pretty small. Then we had the financial crisis, it ballooned up, and then you can see it's been expanding, and then it just kind of popped up here recently to get the stimulus package out. And so the Federal Reserve is providing a boost. And there's an old adage is don't fight the Fed. You know, when the Fed provides liquidity, generally that's a good thing for the markets. And they usually have to do it at a bad time, but when they're providing this much cash into the system, that helps to stabilize things. That's what we're seeing right now. Is there still going to be choppiness going forward? Of course. But they're providing some of that stability. People aren't yelling fire and running for the exits anymore. The hysteria and the panic has calmed down. It's not gone, but it has really slowed. And we're thankful for that, because we've been on the other end of clients calling, really concerned, what should we do? And, you know, our advice has been stick to your plan. You know, that's why we asset allocate, but it's been hard, you know, and I think that, you know, everyone handles this a little bit differently, and it's been tough emotionally, I think, for a lot of different people to kind of weather the noise and the storm, and then the seclusion and the, you know, just all the unknowns. And, you know, this is a big piece of what gave me, I think, more confidence and clarity last week, was that we knew the Federal Reserve was stepping up to provide a boost. And then we also knew the federal government was going to come in with a stimulus, which they have. So if you start looking at what their playbook is, meaning their job is to boost confidence, their job is to reduce volatility. This is the Fed. Their job is to keep interest rates low, because, you know, and then they try to narrow spreads on bonds. They basically what that means is that the spreads widened, which means all the safe bonds like treasuries did well, but corporate bonds, municipal bonds, everything else, the spreads widen. When spreads widen, that means prices of those assets go down. So by them coming into the market, they've kind of brought pricing normalcy back, basically meaning returning gains back to portfolios, and then increased asset prices. So if their playbook has been to buy assets, and if they can increase asset prices, obviously that helps to keep the economy moving forward. So why do they want to keep interest rates low? Big one, mortgage rates decline, right? That's one of the things they want to do, is if they keep mortgage rates low, people keep buying homes, people refinance their homes, it keeps the housing market heading in the right direction. So the Fed's playbook has been pretty clear. This is what they used back in 2008. They used it again. They used it fast. I think we're going to look back on this and say, man, they did a great job because they were able to take action without having to deal with a political piece. They could just go, which was great. So we're pretty confident with what they did. Now we can always, you know, kind of second guess every decision, but generally the decisions they made in a quick manner are really going to help the economy moving forward. Okay, so how big is this stimulus? So this is the fiscal stimulus. This is not the Fed. This is now what the House, the Senate, and the President just passed. And if you look down here on the left-hand side, it basically shows the cost in today's dollars. We're looking at a few pretty big periods in our history. The New Deal, which obviously was in the middle of the Great Depression. Then we looked at the 2008-9 crisis, and then the stimulus we're having now. Now, it's only relevant if you do it in inflation-adjusted dollars or real dollars. So this 2.2 trillion, sorry, that's a mouthful. It dwarfs the New Deal. Now, this is cumulative of the New Deal during the time, not cumulative up until today, because there's still, you know, stuff in place from the New Deal from back then. But this is cumulative during this crisis. And then you can see what was the cost as a percentage of our economy, the New Deal, and then what we're seeing here is about the same. And then cost per capita. Now, this is pretty shocking. So this is basically the cost per person. Cost per person, per person in the U.S. This is costing $6,400 per person The New Deal cost about 1,000. So you can see significant capital that's going in here, significant stimulus. I get it. They're trying to throw, I think I used an analogy last time, the kitchen sink at this. I mean, they're trying to throw anything at it to stop the pain. And they're already talking about phase 4. This is just phase 3. Phase 4 is already on its way. And so as we start factoring in all of these pieces, this stimulus is going to continue to grow and grow. Where did the money go? So if we look at this chart here, we can see 450 billion went to business loans. Those are more larger businesses and medium-sized businesses. 350 billion went to small business loans, which some of them may actually work out to be grants at some point. 300 billion for household payments. Those are the checks going out to households based on the 1,200 and 2,400 for a single and married couple. Then you can see the amounts for unemployment insurance, delaying taxes and tax deadline extensions, relief to state and local governments, the amount to hospitals. So you can see this was full a lot of stuff. We have some things in here like for aid for airline and cargo industry. So there's loans, there's bailouts. So there's a lot of money in this. Most of this targeted at keeping businesses moving forward, because we know if we keep businesses moving forward, what happens? We keep jobs moving forward. We keep jobs intact, I should say. And so that's what's really critical right now is we want to make sure we keep the businesses working, operating, and keep them hiring people or keep them maintaining their workforce. And then we obviously had to get money in individual hands through either unemployment insurance for those that were unemployed, and then or for those, and then I guess for the rest of the citizens just to put money in their pocket. Okay, I think I'm going to skip this one, but this just shows some of the unemployment benefits. That basically shows the unemployment benefits got an extra boost of, I believe, 600 per week. So that's going to help people instead of getting their normal, I believe the maximum is like 495. That might be a little bit off, but they got this extra $600 weekly check, which is basically going to give people on unemployment a significantly higher benefit than they normally get, which is great. I showed this chart last week, and it just kind of shows the scope of actions from left to right is monetary policy, what the Fed's doing, fiscal policy, what the government's doing, corporate and medical responses, then societal response, meaning us. And you can see that the monetary, what the Fed can do, they're almost on empty. So if you remember this chart, E is empty, F is full. So if they're full, that means they have lots left to do. If they're on empty, that means they're almost out. And so you can see the Fed is almost out. The government, they went through phase 1, 2, and 3. So we're kind of in the middle. We're running close to empty. And there's still a lot that can be done at the corporate level, the medical level, and societal level. So things like quick testing, vaccines, things like shelter in home, full lockdown, things that we don't want but might have to happen. And so that just gives you an idea of where we are. We'll continue to update this weekly just so we can kind of follow the trends. One of the big things, and this might be a little complicated one to end on, but we're going to go into this a little bit next week. So I shouldn't say a little bit, a lot next week. So rebalancing. Rebalancing basically means that if you had a target mix of investments between 60% in stocks and 40% in bonds or fixed accounts, not suggesting that 60-40 is the right mix, but let's just say you had that. Rebalancing basically means when you have this 60-40 mix, and because the stock market went down so much, it kind of looked like almost more of a 50-50. So if you look at this chart on the right-hand side, it basically showed if you had 60% in stocks and 40% in fixed, where you were starting the year, and then what happened as the markets collapsed. And so you can see the peak selling kind of stopped here about 2 weeks ago. And at that time, a 60-40 portfolio almost got to 50-50. And then you saw we had the rebound. If everyone, meaning us, meaning all the pensions, all of the like public retirement systems, all of those, if they all rebalanced at the same time and put the portfolio back into their target alignment, this would put about an estimated $2 trillion of money back into the stock market, which obviously would create a ton of buying, which would be a healthy thing for the stock market. So we're going to talk a little bit about rebalancing next week, because we're actually on the verge of going through this for all of our clients. We've been meeting as an investment committee for the last month, making tweaks, making adjustments, making sure we're well positioned for this recovery when it comes, not if it comes, when it comes. So we want to be positioned for this. And so the whole idea about rebalancing is when you have these periods of sell-offs or weakness, this shows you why you want to be rebalancing. You want to be buying into this type of a market, which is a little bit scary, but it allows you to buy things at better prices. And this next chart basically shows, and again, I'm going to skip this for time today, but it basically will show you change in value over time if you took a rebalancing approach over the last 20 years, and then what that looked like for the last 10 years. So we're going to make sure we carve out more time to really kind of, I guess, drill home a little bit of what this really means for clients and the importance of rebalancing. So this data will show it, but it basically shows in this middle chart that using a stock market index, using bonds, and then using a rebalanced portfolio, that in this 20-year period, a rebalanced portfolio actually did better. Now, that doesn't mean it's going to happen always going forward, but I will share some of this data with you next time, and that kind of leads us to our last slide. So next Tuesday webinar, like always, we're going to do Tuesday, and that's April 7th at 4:30. And the discussion we're going to go through, my guess is, I don't want to say we're done on the stimulus, but we have a lot of that stimulus figured out. So what I'm going to get into is a little bit more on rebalancing, talk about planning and investment strategies around Roth IRA conversions, tax loss harvesting, retirement plan contributions. Should you make those now? Does it make sense to? Should you delay? We have 19 to get finished up with, but then we also have this year. And so we'll go through some of those. Hopefully, as a group, you guys can submit some questions. So if you have specific areas around some of these planning ideas, I would love to have that conversation. And then the other thing too, many of you who still get printed statements, your statements are going to be coming out probably on Saturday, maybe Monday. And the numbers aren't going to look pretty because the markets have taken some pretty big losses on and so just know that expect to see the portfolio volatility is pretty severe. We're recovering from that, so markets have come back. But just know, we're here to answer questions. We're here to make sure your financial plan still looks good, still looks healthy. So don't hesitate to reach out. Hopefully these webinars have been valuable. Jared will be back next time. I told you last time he would, but we got so much into the weeds here that I figured I would just cover it today. So I hope you enjoyed this. Again, this is John Vance with Vance Wealth, and thank you and have a great evening.